Hi there, this is Utkarsh Jain and we are on to reading 40 Corporate Finance Working Capital Management for CFA Level 1. The first 2 point of discussion is about primary and secondary sources of liquidity and factors that influence a company's liquidity position. Now, before I start with the specific point of discussion, it would probably generally help just to have an overview of an idea of what working capital management really means. So now, let's think of a scenario. Let us say that a new business is started and the amount of original investment was 500. So this is the total capital which has been invested into business. Now what organization decides is that out of this 500, 400 would be invested into fixed capital of the business. So this 400 might be made of, let's say, plant of the business, or 400 might be invested into building and furniture and other fixed assets. But the remaining 100 was kept in cash. And the reason for keeping them in cash is so that it can be used for day-to-day activities of the business. So after some time, some of this cash was converted into inventory of the business. So let us say that the business purchased inventory of 50. So now the remaining cash position is 50 and inventory is 50. After some time, some part of this inventory was converted into sales, and assuming that these sales were great sales, we would say that now we have inventory of 25 and we have accounts receivable of 25. So what we would say is that when the business started with capital of 500, this 400 was the fixed assets investment that the organization has done, and this 100 was the working capital investment that organization did. And now this 100 of working capital is divided into three parts. Some part of it, which is 50, it lies in cash, some part of it lies in inventory, and some part of it lies in accounts receivable. And we also know that these three assets are also called as the current assets of the business. And therefore, at this stage, what we can simply say is that working capital is equal to the current assets. Okay. Now assume a scenario that the same businessman happens to meet a vendor, and what he says is that he is willing to give inventory on credit. So let us say that he gives inventory on credit worth 100, which means now total of current assets 50 cash, 125 inventory, and 25 accounts receivable. Total of current assets is now 200. But now the question is that is the investment in working capital 200? And the answer is no, because the investment in working capital did not change. It is still 100. But now what business have is business will have one more liability. Since they have purchased this inventory of 100 on credit, they will have accounts payable of 100. So that the current liability of the business would be 100. So what we would say is that though current assets are 200, out of this 200, inventory worth of 100 has been funded by these people, which is accounts payable. Therefore, working capital is equal to current assets minus current liability. It is that part of your capital investment into business which keeps on rotating into one asset into another. So cash would get converted into accounts receivable, and then accounts receivable would get converted into cash, and again I said it wrong. Cash would be converted into inventory, inventory would be converted into accounts receivable, and again accounts receivable would be converted into cash, and this cycle will keep on repeating over the period of time. Now, so what it amply makes clear is that working capital management is about how do you manage your cash, how do you manage your inventory, how do you manage your accounts receivable, and how do you manage your accounts payable. Now, this discussion is about primary and secondary sources of liquidity. Now think of liquidity as how much cash you have available with you. So primary source means the source that a business should generate through its operating activity, which means that if you make sales and this is cash sales, then this is your primary source of business. Or if you make sales on credit but you receive amount from your accounts receivable, you've received some amount from accounts receivable, that is again your primary source of liquidity. Whereas you come to a scenario where primary source is not sufficient. Let's say that you have to make payment of a liability, but you have not made enough sales, neither have you received any money from these guys. In that case, you might be required to probably take a loan, or you might be required to sell some of your asset. So asset sales. So these sources are called as the secondary sources of liquidity. So primary sources of liquidity, sources used in regular operating activities, Example is cash sales, money received from accounts receivable. As against this, secondary sources, these would be used if primary sources are inadequate. An example would be asset sales or debt negotiations. Now, the question is that your liquidity position would be affected by what reason? And here, the purpose of this LOS is that what are those scenarios in which the liquidity position of the company might be in trouble. So it might be in trouble for two possible reasons, that either the money that you're supposed to receive is not being received on time, or the money that you are supposed to pay, you're being asked to pay that very early. So if the money is not being received on time, it would be called as drag on inflows. And the examples would be uncollected receivables, accounts receivable, you were supposed to receive money, you did not. Some of your inventory has got obsolete. That means that this inventory has become old, or it is out of fashion and you're not being able to sell it and convert this into cash. Whereas pull on outflows would be that your vendors asked you to make early payments, or your vendors simply reduce the amount of credit that you would otherwise get with them. Now see that though CFA is being said to be a logical exam, there are certain LOS which would require you to remember certain things, and this is one of those LOS. Now what you need to remember here is that if there is a negative impact on your liquidity because of your inflows, since the LOS uses this particular word drag, you would be specifically required to remember that it is drag on inflows and it would be a pull on outflows. Now this is a question. An example of secondary sources of liquidity is cash received from accounts receivable, trade credit and bank lines of credit, and option number C, asset sales. And of course the answer is asset sales. This is the secondary source of liquidity, which means A and B are primary source of liquidity. A is very obvious, cash received from accounts receivable, and B, trade credit and bank lines of credit. So this is generally short-term loan that an organization has taken in order to take care of day-to-day operations. So these are generally considered as a current liability and part of your working capital. Therefore, these are also primary sources of your capital. Moving on, next question. The condition that occurs when a company fails to generate cash quickly, stretching the company's cash reserve, is best described as. That means you're not being able to receive cash very quickly, not being able to generate. So will it be called as a pull on liquidity, a drag on liquidity, or will it be called as a liquidity mismanagement or management? And of course, what we remember is that with inflows, if there's a problem with inflows, we would call this as drag. And if there's a problem with outflows, we would call it as pull. Since this is a problem with inflows, the correct answer here would be drag on liquidity. So let's go back and check this one more time. That if it is with inflows, it is drag. If it is with outflows, it is pull. And since in our case the problem is with the inflows, and therefore the correct answer here is drag on liquidity. Next point of discussion is comparison of company's liquidity position with its competitors. That means you want to see that how healthy are the cash flows of the company with its competitors, and generally to compare, you generally would not make comparisons in absolute amounts. The comparison would always be done in terms of either percentage or in terms of some sort of ratios, which means that this point of discussion would require us to know certain ratios, and there are two important ratios: current ratio and quick ratio. Now see the intuition behind current ratio, which is simply said as current assets minus current liability. In your current assets, you will have cash, you will have inventory, you will have accounts receivable, and you will have inventory. And in your current liability, you would mostly have accounts payable and other short-term debt. Now, the intention of this ratio is that this ratio would tell you that how many times of your accounts payable you have or how many times of your current liability you have your current assets. And of course, if you have, let's say, current assets of 200 and current liability of only 50, that means you have 4 times the cash required to take care of these liabilities. So generally, as far as liquidity is concerned, it would be considered healthy if the ratio is larger. So this is current ratio. Now the problem with this current ratio is that it is not necessary that this inventory can be converted into cash very quickly. And In fact, you're not even sure whether at all you would be able to convert this inventory into cash, because this inventory might be obsolete, or probably it might take a lot of time to process this inventory and sell. So you want to be more conservative, and the more next set of ratio is quick ratio, where you simply remove the inventory from numerator. So now this is cash plus marketable security, which are at times also called as cash equivalents, and accounts receivable divided by current liability. So quick ratio, and quick ratio would also be called at times as acid test ratio. So quick ratio or acid test ratio, these are more conservative nature of, or conservative type of liquidity ratios. Now we would do certain important set of ratios here, and these are the list of ratios. But rather than remembering these ratios through formulas, we would try to understand the logic behind them. So we would first start with inventory. Now let us say we have two business stores. Business store A, this is, let's say it's a retail clothing outlet, and there's a business store B. Now business store B deals in branded clothing, whereas business store A is a local store. And let's say there's a consumer, and this consumer decides that he wants to purchase shirts for himself, and he decides to visit both A and visit B. Now when he goes to a branded shirt store, and let's say he wants to purchase one, he would not expect too many types and varieties and patterns of those shirts. So probably he would just see 5 shirts and choose one of them, right? So he saw 5 and he selected one. Whereas when he went to the local store, his expectations is that he would want to see more number of shirts before he chooses one. So probably he would see 20, and then after that he would choose one, or the ratio might be different. So the conclusion is that in order to make the same amount of sales, unit A or the shop A would be required to have more number of shirts available at any point of time. So let us say that this A has made total sales of, let us say, 1000 units during the year, and even B has made total sales of 1000 units during the year. But now, to make sales of 1000 units, A was required to have inventory level. Let's say B was required to have inventory level only of 200 units, whereas A was required to have inventory level of 500. So what has happened is that B has done a smart thing here, because it had to have very less amount of inventory, and with that it could sell more number of units, whereas A, it had to stock a larger amount of inventory and it could sell relatively less amount of units. So to convert the same thing into a ratio, 1000 divided by 500, here it is 2, and 1000 divided by 200, here it is 5. This 2 and 5 that I have here, this is called as inventory turnover ratio. Okay, and what conclusion we can draw is that generally longer the ratio or higher the ratio, better it is, which means that this 5 is better than 2, and it makes sense because you invested less amount into your inventory and you could make more amount of sales. Now what is the intuition behind this 5? Okay, so let's have these numbers in mind, 1000 and 200. During the year, the total amount of shirts which have been sold is 1000 shirts. But at any point of time, the average inventory was only 200 shirts. So if we have to simplify this, the way we would think is that the business owner must have purchased 200 units of shirt. He stocked it with himself, kept it with himself for a few days, and then on this particular day, he sold 200. That means during this period, the average inventory was 200. Then immediately after having made sales, he purchased it again, he sold it again. Then he purchased it again, then he sold it again, purchased it again, sold it again, purchased it again, sold it again. So at total amount of sales that he's made total amount of 1000 units of sale, and at any point of time the average inventory that existed was only 200. And since this cycle has been repeated 5 number of times, we call this as inventory turnover ratio. And what it means is that if this was repeated 5 times, on an average, how much time did it take to repeat this cycle once? And of course, the time that it has taken, this is 5 times in a year. So this is 1/5 of a year. That means 365 divided by 5. That means what we have is 73. And this 73 is called as number of days inventory on hand, which we calculated as 365 divided by inventory turnover ratio, which in our case was 5. So the interpretation of this is that the time from which the inventory was brought into your company or your factory till the time you do not make sales of it. This is the meaning of number of days inventory on hand. At times it is also called as average processing time. Now, this is about inventory. Now let's say that again there are two firms. There is firm A and there is firm B. Now during the year, both the firm have made same amount of credit sales of, let us say, 10 lakhs and 10 lakhs, and the average amount of accounts receivable outstanding at any point of time with firm A were 2 lakh and with firm B were 5 lakhs. Now, if I ask you a question that out of firm A and firm B, which one is better, your answer would ideally be that firm A is better. And the simple reason for this is that both of them have made same amount of credit sales, but firm A has lesser amount of accounts receivable. That means the remaining amount has been received in cash. Whereas firm B, it has got a larger amount of accounts receivable. That means it has not been able to collect that excess amount of cash from the accounts receivable. And ideally, the simple thumb rule is that receive your cash as quickly as possible and pay your cash as late as possible. And therefore, we would say that firm A seems to be more smarter in terms of its accounts receivable management. So the same thing, we can calculate a ratio. We call this as accounts receivable turnover ratio. And this turnover ratio in this case is 5, which is calculated as credit sales divided by average accounts receivable. And in this case, the ratio is 2. And again, the thumb rule is that higher the ratio, better it is. Now, again, think of it that this turnover ratio is 5. Now, if the credit sales that was made was of 10 lakhs and at any point of time average accounts receivable were 2 lakhs, that means the firm must have made credit sales here, received money here, then made credit sales, then received money, and same process must have been repeated 5 times over the period of time. So on an average, how much time did it take them to finish this cycle once? That would again be 365 days, 1/5 of a year divided by 5, and that would be 73 days here, which would be called as number of days in accounts receivable or average collection period. That on an average, after having made sales, it takes this firm about 73 days to recover the entire amount of money. Moving on to the next line item. Again, we have two firms now. We have firm A and we have firm B. Let us say that both of them have made credit purchases of 10 lakhs and 10 lakhs in this particular year. But the average accounts payable now outstanding here in this case is 2 lakhs and average accounts payable outstanding here is 5 lakhs. Now if I ask you out of these two firms, which one seems to be smarter, now your answer should be firm B is smarter. And the logic here is that firm A, both of them have made credit purchases of the same amount, but firm A must have paid larger amount and therefore the accounts payable are lower. Whereas firm B must have delayed the payment of that amount and therefore the accounts payable is higher. So in this case, we can calculate a ratio. We will call this as accounts payable turnover ratio. And in this case, this is 5 and this case it is 2. And now we can say that in case of accounts payable turnover ratio, smaller the ratio, better it is. So 2 ratio here, this 2 number is better than 5 because that means you have larger amount of accounts payable and that means that you have delayed the payment. That means you're saving the opportunity cost on those or that money. And again, we can interpret this as that you must have made the purchases and then made the payment here, made the purchases and made the payment. This process is being repeated twice in a year in this case. Therefore 365 divided by 2. So what we would say is that 182.5 is the number of days for which this process was repeated once. So this is called as number of days in payables or average credit period and this is calculated as 365 divided by accounts payable turnover ratio. So now let's summarize the whole thing again, and now you would see a simple technique to remember all of them, that with turnover ratios the numerator is always sales or sales equivalent. So in case of inventory, what we saw is that store had, let's say, sold 1000 units during the year, and on an average it had 200 units. Now if this is in units, if the same thing we have to convert in numbers or in currencies, in rupees or in dollars, if I multiply this 1000 units into sales price, and if I multiply 200 units with cost of inventory, the ratio would not be 5, because of course that sales price, let's say if the cost is 100 rupees per unit, sales price must be 130 or 140 per unit, and therefore if I multiply numerator with a different number and denominator with a different number, the ratio will change. That's why we multiply this 1000 units with the cost and the denominator with the cost, and the number of units sold into cost per unit is called as cost of goods sold, and denominator is average inventory. So again, the numerator is some sort of a sales equivalent. In case of inventory it is COGS, and denominator is average inventory. With accounts receivable, numerator is credit sales, denominator is average accounts receivable, and here with accounts payable it would be credit purchases divided by average accounts payable. And once you have these turnover ratios, then what you would simply say is 365 divided by inventory turnover ratio is the number of days in inventory. 365 divided by accounts turnover ratio, number of days in receivables, and 365 divided by accounts payable turnover ratio would give you number of days in payables. This is Utkarsh Jain. Let us meet in the part 2 of working capital management.